Good afternoon, everyone, and welcome to this week's Coffee and Chats webinar. I'm Richard Kalordi, the Marketing Manager at HLB Mann, Judd in Perth, and the focus of today's webinar is organisations within the not-for-profit sector and what they're facing due to the COVID-19 pandemic. As we know, there are several government stimulus packages available. However, NFPs are dealing with ongoing issues around funding, service delivery, and the introduction of new accounting standards. Joining me today are three guests from the HLB Mann Judd team. With us are Lucio di Giallonardo, who is a partner within the firm's Audit and Assurance Division, Kirstin Stewart, a partner within the Business Advisory Services Division, and HLB Mann Judd's HR Manager, Teresa di Abreu. Welcome, everyone.
Very good.
Lucio, I'd like to start with you first. As someone who's heavily involved with the NFP sector, what are you seeing as some of the main issues currently facing NFPs?
Thanks, Richard, and welcome everyone. At the outset, can I just say that this is the third webinar in our Coffee and Chat series, and it's just great to see how many attendees we have. I think we've got a tick over 60 that are registered, which is absolutely fantastic for a niche industry being the not-for-profits. And at the outset, I'd just like to say that I know a lot of you are doing it quite tough out there at the moment. And just letting you know that we're here to help in any way we can, even if it's just reaching out like some of you have done already for a general chat. Believe me, I get as much out of them as you do. So I guess the majority of not-for-profits have always had to deal with many issues, especially in the revenue generation area. Obviously generating sufficient revenue to be able to deliver the services that they do and meet their objectives. COVID-19 has just added to that list of concerns, and in many cases have made those issues and concerns more critical. So some of the issues that I see are obviously COVID-19 and the flow and effects on not-for-profits. That's obviously been at the forefront of everyone's mind, not only not-for-profits, but all businesses. And I guess most of the inquiries from our not-for-profit clients have been around what stimulus packages are available, how to access them, questions on eligibility criteria for JobKeeper and other packages. Where do not-for-profits go to find out what's available? How do you account for JobKeeper payments and stimulus amounts in the accounting records? A whole range of questions. Luckily, I'm not going to address any of those. Kirstin and Teresa are here to do that. And so they're going to be looking at those matters, including eligibility, etc. So what about other issues? And there are plenty of them. Look, I see funding and access to funding as a critical area for not-for-profits. And I'll distinguish between not-for-profits that rely on government funding and those that don't. For those that do, most of our discussions to date with our not-for-profit clients have been quite positive in this respect. I guess because for 30 June year ends, most of the funding has already been received, and there's no indication at the moment that they're going to be reduced in the next financial year. That's not to say it's a walk-up start or an easy process, as most of you know. It's not just a case of filling in a form. Not-for-profits have got to continue engaging with their funders, make their case for delivery of their services, doing whatever they can to ensure that future funding is assured. For not-for-profits that don't receive government funding or receive very little, I think there are some issues going forward. They're obviously relying on other sources of funding, such as membership fees, events, bequests, general donations, sponsorships, that sort of thing. And I think these will be affected by COVID-19. On top of that are the natural disasters, and we experienced the bushfires over east and locally at the end of 19 and early 20. From my experience, whenever there's a natural disaster, be it these bushfires or previous ones, floods, droughts, tsunamis, general giving reduces. Most of you are aware I'm on the board of a national charity. Our turnover is around 40 million a year. Our income from government funding is a tick under 10% of that, and that's for a specific service that we provide. Now, our major fundraising event, it's an actual event, is held in March every year, unfortunately. This year, our budget was about 17 million in revenue, because that's really what we raised last year. So we've just ticked over 11 million. So it's a $6 million shortfall, which is about, what, 30 or 35%. That's something we've got to make up at some stage, either by increased fundraising going forward, reduction in expenditure, etc. So we've had some interesting board meetings in the last month or so. I mentioned natural disasters. I think that's a classic. The bushfires was a classic example. Look, the fundraising that happened around that was incredible. quite incredible for a very, very good cause. But what it does do, it does focus the attention on that particular event. And through the various fundraisers, you know, the TV appeals, the concerts, etc., they raise an incredible amount of money. You've got the poor old not-for-profit down the road that's having to, you know, scrap for every cent they can get throughout the year. And I guess what it does, those fundraisers do take the focus away from the other charities and does take money out of the general pool that's available elsewhere. The federal government announced the other day, I think, recently, that their research showed that donations to charities had decreased by 7% in 2020, and that's predicted to decrease by a further close to 12% in 2021 due to the effects of COVID-19. That is significant. I guess what's worse is what happens at the end of JobKeeper. Will there be a recovery? How quickly will the recovery happen? How much disposable income is going to be at people's disposal to be able to donate to the not-for-profits and other charities? So funding, I think, is very critical going down the track. Service delivery is the next one. Obviously, when you've got the funds, you've got to deliver the service. And I think COVID-19 restrictions in as far as social distancing, limited regional access, have caused some service delivery to be restricted, unless, of course, the service is classed as essential. What happens if the not-for-profit has received funding to deliver a particular service within a time frame, but due to the restrictions, they haven't been able to deliver that in accordance with their commitments? Obviously, you need to speak to your funders. Funders, I would have thought, especially from government, will be quite amenable to extending that out because of the extraordinary events that we've all faced. So I think it's important to speak to the funders to make sure that they're not going to require those amounts to be repaid at the end of the financial year. I'll touch on accounting standards in a little while. There's a particular link to service delivery when it comes to revenue generation and revenue recording in the accounts, and I'll talk about that in a minute. Next point is, I guess, what is the future going to hold for not-for-profits post-COVID-19? And I guess there's a general concern out there on how the government stimulus packages and specifically the debt that's been incurred will be repaid. COVID-19 has had a significant impact on the federal government's fiscal position, no question. The packages to date, I think 320 billion in stimulus and support payments, which represents 16% of Australia's GDP, very significant. In addition, the state and territory governments have collectively announced another 1 billion in local packages. Now, much of that stimulus is unfortunately going to be funded through debt, and that's got implications down the track. Something that a lot of people are probably not aware of, Australia has got a statutory debt ceiling, initially set up by the Rudd government back in 2007, and it was set at 75 billion. I guess that was done to show some sort of fiscal responsibility, I guess, to set a ceiling so you can't exceed that. Well, 2007, right? 75 billion. That debt ceiling has slowly increased every couple of years and reached 600 billion in 2018. Recently, because of the current stimulus, that figure has now been increased to 850 billion to help fund the current stimulus packages. Scary. Just before his unfortunate coughing fit the other day, our Federal Treasurer said, and I quote, "Australians know that there is no money tree. What we spend today must be repaid later." That's a worry. It's a worry for our future generations, of course, but also, as far as not-for-profits are concerned, there's obviously a need for funding in future, but funding may decrease as a result of that. And in addition to that, there might be tax increases which will reduce the amount of disposable income going forward, which means less donations to charities. So a little bit of a concern there. You're not going to get an accountant in a webinar that's not going to talk about accounting standards. That's our bread and butter. And there are some new accounting standards in play at the moment that will affect 30 June 2020 balance dates. And the ones that are affecting not-for-profits are AASB 15, revenue from contracts with customers, AASB 1058, income of not-for-profits, and AASB 16, leases. Now, we could probably spend a webinar on each of those, but we won't. I'm just going to touch very briefly on each of those. AASB 15, the main talking point on that one is obviously when to recognise revenue. And the basic test there is to recognise revenue that's linked to performance conditions. And those performance conditions have got to be what's called sufficiently specific. As an example, if funding is received to provide research into the causes of cancer. I don't think that's sufficiently specific. However, if that research is for a clinical trial of a particular drug for X number of people, with the results to be published as each trial is conducted, then yes, that is sufficiently specific. And that revenue can be brought to account over the time it takes to conduct those trials. 1058 is the other one for not-for-profits, mainly deals with revenue that falls outside of 15, includes things like capital grants, general donations, and generally that revenue is brought to account on receipt. The standard also deals with leases with significantly below market terms and conditions, such as peppercorn leases. And what it does is requires lessees or leases to be valued, and for the excess of the value of those leases over the present value of the actual lease payments are to be brought to account as income. Now with peppercorn leases, let's say it's $1 per year for the next 80 years, you're not going to bring anything to account because let's face it, that would be immaterial. But if you did, and then the whole lease was valued at an amount that exceeded that, obviously, that balance would need to be brought to account as income, and you would need to account for the lease under 16. Good news though, when that first came out, the not-for-profit lobby was up in arms because obviously to value those sorts of leases would be very expensive and time-consuming. So the Accounting Standards Board came out with an amending standard to say that for those types of leases, let's call them peppercorn leases, you can just bring to account the present value of future lease payments, which are negligible at times, so long as you disclose the arrangement in your accounts, which stands to reason. Disclose what the arrangement is, what it affects, what kind of properties it affects, etc., etc. So the Accounting Standards Board came out recently and said that exemption would be extended. Not sure how long for, so we'll keep you informed as to how that goes. And then of course 16 on leases, I think we're all aware that you need to record now for previous leases that were called operating leases, such as leases of properties, equipment, etc. Record an asset, right of use asset, and record a lease liability for the corresponding liability. There's a couple of exemptions for short-term leases and low value items, but in general terms, yes, you need to bring that account as an asset and liability. And I noticed, Richard, there's a question that's come up. Is there any talk of deferring these standards because of COVID-19? No, there's no talk, and I don't think that's ever going to happen. Two reasons. These standards have been in place for financial years commencing on or after 1 January 2019. So people have had plenty of time to address them. Also, for 31 December balance dates, that has already passed. 31 December 19 financial years, they would have already been applied, and those accounts would already be signed off or about to be signed off. So we've got 30 June 2020 coming up for the 30 June balance dates. If there's a deferral, you have a situation where there are some entities during that period, being 31 December 19, that have applied the standards and some that haven't. So no, I don't think there's any chance of them being deferred. And another question on this that came up yesterday, I think, was please advise on the correct treatment of COVID-19 rent holidays within AASB 16. Look, that's a great question. And I hope it's a frequent question because that would mean that you've been able to negotiate some rent reductions, which is great. Complicated answer, so I won't dwell on it. I know that we've got a webinar coming up in June from our technical director, Michelle Warren, that's going to deal with these standards, so we can address it then. However, in general terms, these rent holidays, if they form reductions, waivers, deferrals, or a combination, have got to be assessed as either lease reassessments under the standard or lease modifications. And we're told that the Accounting Standards Board is going to come up with an amendment soon to allow you the choice to call it a lease reassessment. So in other words, when you do your model and you forecast what your rent payments are going to be, if those payments have reduced, well, that gets factored in to that assessment and it affects the calculation of the right of use asset and the lease liability. I just want to go back quickly to the point I made about service delivery and how it links into the accounting standards. So if there's a restriction on the ability to provide your service, but you've been funded for it, under the new standard, again, if those service performance obligations were sufficiently specific, it means that you can bring that revenue to account over that period of time. So what happens if you have been unable to provide that service and meet those milestones? First thing is to talk to the funder to make sure you don't have to repay the money. Secondly, if they allow you to extend the period of time over which you can deliver that service, well, then it stands to reason that revenue can continue to be brought to account over that extended period of time. That's that in a nutshell. I think that's probably it as far as the issues are concerned. If I need to make any comments later on any of the other points that come up, I will do. But for now, back to you, Richard.
Thanks, Lucio. Now, you touched on JobKeeper just for a second there. Kirstin, my next question is for you just around JobKeeper. How does an NFP know if they qualify for the reduction for the 15% rather than compared to the 30% or the 50%?
Okay, thanks, Richard. So the first thing you have to consider is that you've got to look at the first step is actually saying, is the aggregated turnover of the group in excess of $1 billion? If it is, you actually have to show a reduction of 50% or more. Now, so we're just going to park that one aside because you certainly need to be at the very high end of town to meet that. If your aggregated turnover as a group is less than $1 billion, the rules state that you need to show a 30% reduction in your turnover to be eligible for the JobKeeper payments. However, what has happened is that there was an additional component added in that if you are an ACNC registered charity, you only had to show a reduction of 15% of your turnover to be eligible for the JobKeeper payments. So the term we often use generically for NFP, that in itself isn't specifically defined because they only talk about whether you are an ACNC registered charity for the purposes of being able to show the 15% reduction to be eligible. So I guess most people will know if they're a registered charity with the ACNC, but there will certainly be a number of not-for-profit organisations that are not registered. So unfortunately, in that instance, you would have to make sure that you can demonstrate a 30% reduction to your turnover or 50%, as the case may be, to be eligible for the JobKeeper there. Just one little caveat on that is that you may be still, so a university or a school, so a school defined under the GST Act, would actually still have to demonstrate a 30% reduction rather than a 15% reduction, even if you are registered with the ACNC. So there was a little bit of an exception there that unfortunately universities and schools, even if they are registered, still need to make sure it's a 30% reduction rather than a 15% to be able to be eligible. There's a couple of other little bits and pieces in the eligibility. I might just touch on those at the moment. Obviously, you need to have eligible employees employed by the organisation as at the 1st of March. So you obviously need to have eligible employees to be able to get the subsidy payment in the first place. There are some other little exclusions that may relate more to not-for-profits that's worth mentioning, that you cannot be an Australian government agency or a local governing body or wholly owned by an Australian government agency or local governing body to be able to get JobKeeper. So unfortunately, government organisations are excluded from JobKeeper as well if you're owned by a government. The only other one is just if the entity is in liquidation, it probably stands to reason that that might be why they're excluded. So I certainly think the first step in understanding JobKeeper is understanding what type of entity you are and whether you have to meet a 15% or a 30% reduction in order to be eligible. So that's the first step. I guess the second part of all of this is that we often get asked, and I think this has come up significantly already, is fine, I know now whether I need to show a 15% reduction or a 30% or even 50%, but how do I actually know what to include in my GST turnover? So there's a couple of questions there that, you know, specific to the not-for-profit sector that I'll touch on, but just initially, the GST turnover for the purposes of JobKeeper, it's defined by the GST Act, but you don't actually need to be registered for GST to be eligible for this. So, I mean, that might only really relate to some micro not-for-profit organisations anyway, but it is the turnover that's defined by the GST Act as GST turnover. Now, when we consider that, whether it's the 15 or the 30% reduction, what you need to do to meet the basic test is you actually go, okay, what was my turnover in March 2020? Compare that to your March 2019, and then you can compare the percentage, and if you have that 15 or 30% reduction, then you should be eligible. Now, let's say you don't meet that for March, you can then consider April. Now, April obviously now has passed, although when we first started talking about this, April at that point might have been a projection of your income through to the end of April, but you basically then can look at your April 2019 compared to 2020 and again assess your percentage reduction to determine eligibility. The final component, again, if you potentially failed for that, you could also look at your quarter for April to June. And in that circumstance, even right now, you'd be looking at your projected income for that time frame and compare your April 2019 to June 2019 to your April 2020 projected through to June 2020. So again, you can use those time frames to be able to compare your percentages to see whether you can fall in. Now, if you fail one of those tests because, say, the organisation didn't exist in March 2019, or maybe like Luch was talking about before, you were affected by bushfires in the past or a drought or some other natural disaster, that your prior year period doesn't actually reflect what you might have actually incurred as income, there are some alternate tests that you can look at for eligibility. I'm not going to go into that in too much detail, just know that there's sometimes some other tests that you can potentially look at because those alternate tests are quite complex. But essentially that's how you can assess your 15 and 30%, and those timeframes is what you compare. Now, when it comes to the GST turnover, the definition of that, like I said before, is related to the GST Act, but there was some additional changes announced. If you are an ACNC registered charity, that you could elect to include or exclude your government revenue from those calculations. So for some, that you may have made a big difference in terms of whether you met it or whether you didn't. Now, you had a choice, so you could choose the method, of course, that gave you the percentage that put you in JobKeeper territory or not. But if you elected to either include or exclude that revenue, just know that that election, you need to apply that same principle with the monthly declarations going forward. So one part of the ongoing enrolment for JobKeeper is that you need to each month show your actuals and projection for the next month in these monthly declarations. So if anyone's done one already, they'll know what I'm talking about. And you need to be consistent in your approach of including or excluding the government revenue that you already made the decision of whether you met it. So that just needs to continue going forward. There is another little component that also came out in relation to ACNC registered charities, that where you make the election to exclude government income from your eligibility calculation, you are able to exclude those employees from the JobKeeper program that would otherwise be eligible, but for whom you could reasonably identify that their remuneration is sourced from that government income. So just to note there that where you have chosen not to count income from that government source in your eligibility calculation, you do not have to exclude that employee from that. You can just choose to. So this exclusion is not automatic, but it is a choice of the employer. Just another couple of components around the GST turnover. So if you are a DGR, so a deductible gift recipient and registered as such, you are required to include gifts that are received or likely to be received when we talk about that projection component we were discussing earlier. That would be tax deductible to the donor, so they need to be included. Now, if you're not a DGR, you must still include gifts that you receive or likely to receive that are made by way of a monetary donation, property with a value of more than $5,000 and listed Australian shares. Another late-breaking change was that bequests are included in your GST turnover, but there are a couple of things to be mindful that are excluded from your GST turnover for purposes of this calculation, and that's what's called input tax supplies. More commonly, you will know that as dividends, interest, unit trust distributions, and also residential rent would also need to be excluded. So that just gives you a really broad idea of what you've got to do in terms of first step is to identify whether you have to meet a 15 or a 30% reduction. And then once you know what your percentage is that you need to be looking at, the next step is then working out what's in the turnover to actually get to the calculations.
Thanks, Kirstin. My next question, Teresa, is for yourself. I do have a question that's come through. Can an NFP reduce the hours worked by employees to the equivalent of the JobKeeper payment of $1,500 per fortnight?
The answer is yes. Under the Fair Work JobKeeper provisions, an employer can request a reduction in hours. But there is a process that they need to follow, which is that they do need to notify the employees and give them 3 days notice, or unless otherwise agreed, it can be shorter than 3 days. And once they've notified them, they need to consult with them to come to an agreement, and then that agreement needs to be put in writing. So the answer is yes. And due to the Fair Work Act JobKeeper provision, it does make it a little bit easier for people to be able to have those conversations, and staff would need to reasonably agree to those changes.
What about if an NFP has employees that are paid less than the $1,500 per fortnight because of their hours and duties? Can the NFP force them to work longer hours up to the equivalent of the $1,500?
Well, the short answer is no. And I think the word that you used there was force. Everything here has to be done with agreement between the employer and the employee. You know, so if they make arrangements to put in the extra hours, it needs to be an agreement between the employer and the employee. And this is where communication is extremely vital. Employers need to be transparent about what the situation is. Everybody's in this together. I know that we hear this all the time, but it's true in that, you know, it affects the employees. It's having that conversation about what is the long-term plans for the organisation. We want to be at the end of this. We want to get through it. So how can we work together? If the only reason an employer is actually requesting them to work the extra hours because they don't want to pay the top up that they need to on the JobKeeper stimulus, that's not a reasonable request. If it is a case of there is extra work they could do, where you could, because also under the JobKeeper provisions, you can also ask employees to do different jobs in different areas, as long as it's within their skill set. So it does come down to communication and making sure that everybody agrees.
What about if an NFP had employees that were stood down due to COVID-19 and are currently on paid or unpaid annual leave? Will they still qualify for a JobKeeper?
Yes, they would, as long as they were permanently employed on the 1st of March, like I said earlier. If they were casuals, as long as they were employed on a regular and systematic basis for 12 months prior to the 1st of March. So yes, the answer is yes.
Okay. I do have a couple of JobKeeper questions that have come through, but I just wanted to ask you about a mental health question with regards to NFP and employees. Because it's such a time of uncertainty, how do people maintain their mental health during this time? And what should employers be doing in respect to ensuring employees are engaged?
I think it's important, depending on whether you've stood down employees or whether they actually are just working from home, is to stay connected, because we all, you know, going through this uncertain time, and humans generally, we like stability, we like certainty. The minute that, you know, it creates anxiety and a lot of angst when we're not sure of what, you know, what's going to happen. We worry about our health, our family, financial situation, etc. You know, so it's important that this is when employers need to stay connected. If you stood down employees, stay in touch with them, because the reason you've stood them down is because you want to see them come back into the organisation at a later time. So don't just forget about them and hope that, you know, you'll say hello again, you know, a couple of months later. It's important to stay connected, just to check in on them, to see how they're doing. One of the things I found really interesting right at the beginning of, because at HLB a lot of our staff started working from home, and in checking in on them just to see how they were doing, the word lonely came up quite often, in that people felt, you know, especially those people that, you know, didn't necessarily have a family or didn't have other people staying at home with them. And so they kind of felt a little bit lonely and were quite keen to get back into the office. Interestingly enough, some of them seem to have adjusted, and that's the other thing about human behaviour, is that we do adjust and adapt quite easily to the different situations. But for me, it's that connection, is staying in touch. The staff at HLB Mann Judd also know that I'm a stickler for the video conferencing. I want to see your face when I'm chatting to you. Because that's my way of connecting. It's my way of knowing and checking in on you and seeing that you're okay. You know, just a telephone call is not going to give me enough information. So it's just staying in touch. Keep talking to people. Just know that you're there. The other thing is that as more employers now starting to talk about is going back to the office. There's a lot of concern and angst again now, because now we're changing the situation again. I'm going back to the office. is it going to be safe for me to go back to work in the office? So what we need to do as employers is ensure that we have created an environment that is where people feel safe. So I guess, I suppose I can use HLB as an example in the discussions we're having at the moment about getting back to business, so to speak, is about creating an environment that is, putting in hand sanitizers, putting arrows on the floor just so that, little one-ways, etc., so people know that to socially distance, because we want to get as much of the team as we possibly can back into the office. We know we probably won't get everybody at the same time, but having those measures in place so that when people do come through the door, that they feel safe, they're comfortable in that environment. So it just reduces the stress again.
Mm-hmm. Okay, I'm going to cross over to some of the audience questions now. Lucio, this one I would imagine is for yourself. With philanthropic support declining, have you heard if the government is considering changes to stimulate philanthropic giving?
Richard, no announcements yet in relation to general donations. I guess it would be nice if the government said, look, for every $1 you donate, you can get $1.20 as a deduction. That would be lovely, but I think that's unlikely given issues about debt levels and repaying that going forward. But I think it was on Tuesday this week, the government did announce some changes that affect private and public ancillary funds. I think we've got someone on the webinar that this affects as well. Just quickly, there are regulatory minimum distributions that those funds have got to make each year. So in other words, public ancillary funds have got to distribute at least 4% of their net assets each year, calculated on the previous balance date. Private funds have got to distribute a minimum of 5% their net assets each year. And so generally those distributions go to charities. The recent change, and it gets a little bit complicated, is that if those funds grant at least 4% more than their minimum annual distributions across the 2020 year and 2021 year, they'll be eligible for a partial credit for future years. Mm-hmm. So the credit equates to half of the excess distributions they make this year. And then that excess can be used to the tune of 1% each year until the excess is consumed. So a little bit complicated, but yeah, that's to really stimulate the amount of distributions that these funds can make to charities right now when it's needed.
Okay. The next audience question possibly is for yourself, Kirstin. Should you elect to exclude government funding and the remaining revenue is only 8% of total revenue, can you still qualify?
I would think that you wouldn't say it's 8% of your total revenue. You need to compare again those quarters. So you still need to come back to the quarter or the month from the prior year to this year and actually compare that GST turnover. So whether you say total income, it's not necessarily total income over the 12 months, and whether that's only 8%, you'd still need to go back to that March or that April and compare again. And you would either make the decision to include or exclude the government revenue. And then if one option gives you the better result, then, and that puts you in the realm of being over 15% or 30%, then you're okay. It doesn't necessarily mean, oh, it's 8% of your total revenue. So I think if you found that excluding the government revenue, you only had a reduction of 8%. I'm not sure if that's exactly where they were going with that question there, but then if the reduction of the revenue isn't over 15% or 30%, then unfortunately you won't qualify. So I think I've checked the answer. I can always come back to someone if I need to clarify further the point there, if I've misunderstood exactly what they're asking. So yep, I think that deals with that.
Yep. Once again on JobKeeper, NFPs often chose to classify fundraising sales to be input taxed, in particular tickets to events, also not claim GST component on purchases in relation to that event. Should these be excluded from GST benchmark and estimate calculations?
I think if it meets the I think you've said there that they've chosen to call it input tax credits without looking into the detail. If it is technically defined as an input tax credit, then that does need to be excluded for the purposes of the turnover. I mean, I use the examples of interest and dividends, but effectively, if under the GST Act, the input tax credit is how it would be defined, then it needs to be excluded from the GST turnover calculation.
Okay. What happens if the decline in income is due to timing of government receipts, but no decline in income over the year compared to previous year?
I think because your GST turnover, again, I mean, some people report on an accruals basis or on a cash basis. So I think the difference will be you have to be consistent on how you've actually been reporting. So you would consider if you're March 2019, I mean, there's always going to be timing differences, but if you've always been on a cash basis, if this isn't clear when you're going through the tests, you may be able to then consider with one of the alternate tests actually work, because sometimes the alternate tests actually take into account lumpy types of income and when you receive it. So that's where, again, if you fail the basic test, you would then go back to the alternate tests and see if there's one of those alternate tests that can work. So yeah, and we've had a couple of examples with clients where we've had to look at the alternate tests and say, okay, someone gets lumpy income or it's not clear. So you can look at those and see whether that helps get you in. We would certainly be trying every avenue under every part of the legislation to get you in, rather than if the first run at it under the basic test you don't quite get there, we might go, but we still feel like it might, so let's have a look at some of those alternate tests. So that's what I would recommend as the second phase if it's not clear in the first instance.
Okay, just with regard to deadlines, last week HLB Mann Judd's tax consulting partner Guy Brandon mentioned that Friday the 8th of May was an important deadline date for organisations. Where are we in the application process for NFPs with regard to JobKeeper? What are the important dates?
Yeah, the date of Friday the 8th was one of our first deadline dates. Isn't specific to the NFPs, this is for everyone, but essentially if you had payments to employees that you needed to make a top-up payment that related back to one of the prior fortnights, the first fortnight starting the 30th of March. Certainly in what we found is that people in those first weeks didn't know whether they were going to qualify or still had to go through that eligibility criteria and just paid some of their staff as normal, and may not, if those staff members earned 1,500 gross or less, didn't necessarily top them up to that 1,500 gross per fortnight. So the date of the 8th of May was the deadline to get any of those back payments paid, and certainly anyone that needed those top-up payments for you to go back and get JobKeeper payments applicable from that 30th of March date, which was the start of the first fortnight. So the government certainly recognised that people may not have known to do that properly in those first few weeks, and has given that time frame of the 8th of May to get those payments done. So that date unfortunately has passed, but then in terms of dates and deadlines, I guess our next one is the 31st of May. So the 31st of May, if you wish to enrol for the month of April, you need to say, okay, I need to get the enrolment done, which you can do through your online business portal, or a tax or BAS agent can help you. The first step is the enrolment. The second step is actually to identify all your eligible employees. Now, there might be some employees that you have that may not be eligible for some reason. They may be getting JobKeeper from another employer, for example. They may not have been a casual for the more than 12 months. There's some people that may not be. So in your business portal account, if you use STP software to do your payroll, they should all be pre-filled in there, and then you should be able to go through the process of ticking and which ones are eligible for which fortnights you wish to claim. And then the final step of the enrolment has to happen is your monthly declarations. I referred to that before, that the amount of the income that you have to declare. On the 31st of May, you need to have declared your actuals for April and also your projection for May. Now, obviously, if you did it right on the last day, your projection might be pretty close, but that's the final step that needs to be done for your April and your May, and that's the 31st of May. But going forward, you need to do that by the 7th of the month following. So, for example, for May, you need to tell the ATO by the 7th of June your income for the month of May actuals and June projection, as well as tick off all your eligible employees for that time frame as well. So the 7th of each month going forward is going to be those next critical dates that you need to have got that done by, so you want to start receiving your JobKeeper payments. So yeah, okay. Unfortunately the 8th has passed, but the next critical date is the 31st of May.
Okay, just for the last 5 minutes, we've got 3 questions that have come through from our audience. The first one might be for yourself, Lucio. If an organisation meets the JobKeeper criteria due to implementation of AASB 15, i.e. the deferral of income relating to future financial periods, would that be allowed under ATO criteria?
I believe so. This actually came up the other day with another client, and yes, it did refer to the application of Australian accounting standards. So yes, it would.
Okay. If an employee has full-time work elsewhere, however works with our organisation part-time for the past 15 years, can we ask for JobKeeper for them?
The employee would have to sign a nomination form. So it will depend on whether they've already done that with the other employer, because it's up to the employee to choose which employer would be their primary employer. So if they've already done that where they've signed with the other employer, so the answer is no. But if they choose to go with you, then yes, then you can apply for them for JobKeeper.
Okay. Right, okay. Some have interpreted the start date of March 30 for JobKeeper as meaning the date payroll was paid to staff, not the start of the pay week. Are you able to clarify?
So I can answer that one. Yeah, so the 30th was the start of the fortnight in which you needed to qualify for JobKeeper. So that if you qualified within that fortnight, then that's the fortnight for which you can receive the payment of which it relates. Now, there's obviously going to be differences of when people actually make the payment to their employees, but you do need to, you know, sometimes you get paid monthly or weekly and whether it's the fortnight, but effectively you will only get the subsidy for $1,500 gross a fortnight for that fortnight. The first one starts on the 30th of March and it ended, I think it was the 10th of April. And that is the time frame for which you will get the subsidy. So you do need to try and match, if you need to top up, the payroll that relates into that time frame. So yeah, I think if there were a few questions, and we can always work it out if we need to, like, and talk to someone specific and say, well, when was their pay? And you can actually calculate it out. So they do say you've got to try and match it as best you can to get those amounts within those fortnightly timeframes.
Okay, a question has just come through about the deadlines, JobKeeper deadlines. If you missed the 8th of May for a couple of employees, are those employees just excluded from the claim for subsidy? For
that fortnight, you could then make sure, or those, I think it was for the first 2 fortnights you had until that time frame. But as long as, I think that's within the next fortnight, you need to get the top-up payments for the next fortnight. So unfortunately, yes, if you didn't get those top-up payments, then you would probably say they're not eligible to get the JobKeeper reimbursement for those people.
Okay, just with the last couple of minutes, getting off JobKeeper for 1 second, I just wanted to ask the group, once the current restrictions are lifted, do you think the whole fundraising landscape will change for NFPs going forward?
Look, I can do with that one. Look, I think it will. I think I said at the outset that certainly for non-government funding, things are going to change. So I guess event fundraising, whilst I'm not a fundraiser, I must admit, things like event fundraising that involve a lot of contact, you know, even if the restrictions as far as distancing go, I think it's just going to become the new normal. Event fundraising will probably end up diminishing as a fundraising tool, so people will be looking at other forms of funding. So I think the landscape will change, and also, as I said before, in as far as repaying that debt, I do think there's going to be less disposable income going forward. So it means that, look, not-for-profits is going to have to continue scrapping for every dollar, keep beating the drum as far as what your cause is, what your objectives are, speak to new potential sponsors, especially larger companies. And in fact, I know anecdotally there's been a couple of the larger mining companies that have actually provided COVID-19 specific funding for some organisations. So going forward, hopefully that's going to be available as well.
Okay, thanks for that, Luch. What I'm going to do now, just before we wrap up, is I'm going to launch a poll for our attendees. If you wouldn't mind answering that question. I would like to just thank Teresa, Kirstin and Lucio for their time today. We've just hit 3:15, so we're right on time. If any of the attendees would like to get in touch with the firm and have further questions, you can always email hlb@hlbwa.com.au. But until then, we'll see you all at the next Coffee and Chat webinar series. Thanks, everyone.
Thanks,
Richard.
Richard.